Welcome to The Explainer. Today we're diving into the race for arbitrage, from bananas to microseconds. We're going to trace the fundamental laws of trade, literally from the absolute basics of jungle economics all the way to the invisible, high-stakes battlegrounds of modern finance. It's a wildly fascinating progression, and you know what? It actually impacts the money sitting in your retirement account right now. I'm thrilled to have you here to unpack this whole thing with me. Let's get into it.
So I want to start things off with a slightly weird question. What do a monkey selling bananas and a supercomputer trading in microseconds actually have in common? I know, it totally sounds like the setup to a bizarre joke, right? But the answer connects the most basic rules of commerce to a $5 billion invisible war that is happening right now in our global equity markets. To understand this hidden battle and why it matters so much to everyday investors like us, we're going to look at three very different sources.
Section 1. The monkey business of arbitrage. Okay, let's dive right into this. With our first source, it's this brilliant and, honestly, slightly ridiculous breakdown from a YouTube channel called Primate Economics. We're starting from square one here just to build a really rock-solid foundation.
We're talking about arbitrage. Now, as our source playfully points out, it's not espionage, it's not camouflage, and it's definitely not an entourage. Simply put, arbitrage is the act of buying something where it's cheap and then immediately selling it where it's more expensive. Honestly, it's the holy grail of trading. It's the ultimate risk-free profit. Well, assuming you know exactly what you're doing and exactly where to look.
So imagine a clever monkey. He figures out that in banana land, a banana costs just one leaf. Pretty cheap, right? But if you travel over the mountain to monkey land, well, bananas are incredibly rare there, so they cost 5 leaves. Our monkey buys a banana for 1 leaf, hikes over the mountain, and sells it for 5 leaves. That is pure profit, driven entirely by a geographical price difference. He didn't grow the banana, he just exploited the fact that those two markets were disconnected.
Moving on to Section 2, the rules of the game. Let's shift over to our second source, a really detailed article from IFL Capital, to see how this concept scales up from our hypothetical jungle into actual global markets.
They formalize this exact concept as spatial arbitrage. So we aren't trading bananas for leaves anymore. Instead, think about real-world commodities or complex financial assets. If crude oil prices happen to be lower in Delhi than they are in Chennai, an arbitrager can buy the oil in Delhi, sell it in Chennai, and just pocket the difference. It's the exact same mechanic as our monkey, just scaled way up across regional economies and real-world supply chains.
But that raises a pretty massive question, right? When is this actually possible? You can't just randomly buy and sell things across the map and expect a guaranteed return. Modern markets are incredibly efficient. Information travels fast. So for an opportunity to be truly risk-free, there are strict rules that absolutely must be followed.
According to IFL Capital, 3 precise conditions have to perfectly align for an arbitrage opportunity to truly exist. First, it has to be the exact same asset trading in different markets. Second, the assets must have the same cash flow. Think of a bond paying the exact same 5% interest in both places. And third, the asset has to be trading at a discount from a predetermined future price relative to its risk-free interest rate. Basically, the math of the future payoff has to guarantee a win. If all 3 of these stars align, boom, the arbitrageur steps in and makes a completely risk-free profit. But finding those misalignments, that takes incredible precision.
Which brings us to Section 3, the microsecond arms race. Now, this is where the narrative shifts drastically. We are leaving the physical world of crude oil and cargo ships entirely, and we're entering the digital ether. We're drawing this next part directly from a fascinating research paper from the National Bureau of Economic Research, or NBER.
We're now looking at what researchers call latency arbitrage, and it's the exact same concept of spatial arbitrage, but instead of traversing physical miles, these modern traders are racing across fiber optic cables at the literal speed of light. High-frequency trading firms are exploiting tiny, temporary price differences between electronic exchanges. To pull this off, literally to shave off fractions of a millisecond, they even physically locate their supercomputers right next to the exchange's computers inside data centers, just to get that physical head start. It's wild.
The sheer, incomprehensible speed we're talking about here is just staggering. The NBR researchers actually analyzed 2.2 billion messages from the London Stock Exchange to map out this invisible battlefield. They looked at the time gap between the winner of the trade and the losers who sent failed orders. The average duration of one of these digital races, 79 microseconds. That is 79 millionths of a second. Just to put that into perspective, the blink of a human eye takes about 300,000 microseconds. That means thousands of these races can start and finish before you even complete a single blink.
And if you think this is some rare, isolated occurrence, think again. In the FTSE 350 index alone, the researchers found there are, on average, 71,000 of these races happening every single day. The volume is astronomical. That translates to about one race per minute for every single ticker in the FTSE 100. It's just a continuous, relentless digital war raging right beneath the surface of the normal market.
So, here's the crucial point. With all this incredible supercomputing power, the insanely expensive fiber optic cables, the massive physical infrastructure inside these data centers, what exactly is the prize for winning this millionth of a second race? On average, the profit from winning one race is a measly £2 sterling. £2! It almost makes you wonder, why do these high-frequency trading firms even bother investing hundreds of millions of dollars into this arms race just to win the equivalent of pocket change?
Well, here is the staggering punchline. When you run 71,000 races a day and you compound those tiny £2 profits across global equity markets all year round, it adds up in a major way. It aggregates to an estimated $5 billion annually. $5 billion, extracted globally from microscopic, fleeting inefficiencies that last less than a thousandth of a second.
Which brings us to our final section, number 4, the hidden tax on liquidity. What does this high-frequency arms race actually mean for the broader market? And more importantly, what does it mean for everyday investors like you and me? Let's look at what researchers call the hidden tax on liquidity and how those billions of dollars are actually funded. The NBR data reveals a pretty shocking reality about the composition of our markets. These latency arbitrage races make up roughly 20% of the total daily trading volume in the FTSE 350. Just pause and think about that for a second. 1/5 of all market volume isn't traditional investing. It's not companies raising capital or investors buying stocks because they believe in the business. No, it is literally just algorithms racing each other in the dark for £2 coins. And it turns out these firms aren't exactly providing a helpful service to the rest of us. The researchers found that the top 6 high-frequency trading firms are primarily doing something called sniping stale quotes. This means they're using their immense speed advantage to buy or sell assets at outdated prices right before other, slower traders even have the chance to react to new information. Because they get there first, on net, these top firms are actually removing liquidity from the market rather than providing it. Because of this continuous high-speed sniping, regular investors end up paying an invisible premium every single time they trade. The researchers calculated this liquidity tax to be approximately 0.53 basis points on trading volume. Now, a basis point is a tiny fraction of a percent, so 0.53 doesn't sound like much on a single trade, right? But if you're an institutional investor managing pensions, mutual funds, or 401ks, and you're trading huge volumes every day to secure people's retirements, this becomes a massive, continuous drain on your returns. It's basically a friction that constantly eats away at global wealth.
But there is actually a path forward. The NBER estimates that if structural financial market reforms were implemented, changes designed specifically to eliminate latency arbitrage, like, say, batched auctions instead of continuous trading, it could decrease investor liquidity costs by a highly significant 17%. Fixing the market's digital plumbing could literally save everyday investors billions of dollars a year. It would redirect that money from the high-frequency traders straight back into pension funds and retirement accounts where it belongs.
So as we wrap up, we really have to ask ourselves a vital question. If $5 billion is being made in the dark, in fractions of a microsecond, who is really winning the race? And more importantly, who's paying that hidden tax? Because it turns out, whether you're a monkey just trying to save up a few extra leaves in the jungle, or a retirement fund manager trying to secure your client's financial future, the fundamental laws of arbitrage remain exactly the same. Only the speed limit has changed. Thank you so much for joining me on this explainer. I hope this helps you see the markets in a whole new light. Keep learning and stay focused.